Okay, so you've got $10,000 to invest. Here's the hard truth. Most people are playing the wrong game entirely. They're hunting for that one magic stock, treating the market like a lottery ticket. And honestly, that's a high-stress, low-probability way to do things.
Look, let's just be real for a second. That whole fantasy of picking the next Amazon or Tesla, for almost everyone, it's just that, a fantasy. The data is just crystal clear on this. Hunting for individual stocks isn't how real wealth gets built. The real secret is in something called asset allocation.
So if stock picking is the wrong game, what's the right one? Well, it's not about trying to pick winners. It's about building a system, a framework that dials down the stress, takes the guesswork out of it, and is actually built to work for the long haul. And that's exactly what we're going to break down.
We're going to give you the exact mental model for that first 10 grand. And hey, if you want more frameworks like this that just cut straight to the point, make sure you subscribe to Money Mindset. All right, let's dive in. First things first, we have to get our heads around what actually moves the needle in a portfolio. And spoiler alert, it is not what most people think it is. Okay, get ready for this number because it kind of changes everything. A huge study by Vanguard found that about 91% of your portfolio's long-term performance comes down to just one thing, your asset allocation, not the stocks you pick. Let that sink in, 91%.
So what does that actually mean? It means the mix, the percentage of your money in big categories like stocks, bonds, and cash is way, way more important than whether you picked Apple over Microsoft.
Okay, so if the mix is everything, the obvious next question is, how do you build a mix that doesn't just get totally wiped out when one part of the market inevitably tanks? There's actually a brilliant, super simple analogy for this. Just picture a street vendor. When it's sunny, they sell a ton of sunglasses, right? But zero umbrellas. And on a rainy day, it's the complete opposite.
See? By selling both, things that do well in totally opposite conditions, the vendor has a much smoother ride and cuts down the risk of having a terrible day. And that, in a nutshell, is diversification. You own things that don't all go up or down at the exact same time.
So, we've got these two huge ideas on the table. Asset allocation is king, and diversification is your shield. How do we actually, do that with our money? Well, that's where this practical strategy called the core satellite approach comes in. This is it. This is a simple, really powerful way to think about structuring your 10 grand. You've got this big, stable center, that's your core, and then these smaller, more specific bets orbiting around it, which we call the satellites. Think of it like this. Your core is the boring, stable foundation. Its job is just to get you the average market return, probably with something super simple, like a low-cost index fund. The satellites, on the other hand, that's where you make your strategic bets. This is where you might put some money into a specific sector like technology, where you're actively trying to beat the market, even if it comes with a little more risk. Okay, let's get super practical. With your $10,000, you could start with a classic 80-20 split. That means 8 grand goes straight into your core, a simple, cheap, total market index fund. That's your foundation. The other $2,000, that's for your satellites. Maybe you believe in clean energy, or maybe you want a little exposure to emerging markets. That's where you put that money. Okay, so we have this strategy. But here's the last and maybe the most important piece of the puzzle. You can have the perfect system, but it's totally useless without the discipline to actually stick with it. And this right here, this is the massive mindset shift you have to make. Stop trying to outsmart the market. It's a game very, very few people win. Your real goal should be to build a portfolio that can withstand the market's craziness, a system built on principles, not on panic. And this really brings it all home. Look, expected returns guide the strategy, but your written plan is what keeps you disciplined when markets get noisy. That simple rule you write down for yourself, like I will stick to my 80-20 split and rebalance once a year. That is your defense against your own worst emotional impulses when everyone else is freaking out.
So, it's time to stop. Stop the stressful, high-stakes hunt for that one single needle in the haystack. Instead, just buy the haystack. Own the whole market in your core and build out from there. That is the smart, low-stress way to invest.